Okay, welcome to the December 6th edition of the Fats, Fuels, and Oils webinar. This week we've got a lot to cover. We obviously are going to talk about the EPA mandates and their implications for biofuel production and feedstock demand. And then we'll go through, that's probably going to take up a big chunk of time, and then we'll kind of go through our usual review of the gross margins and credit price forecasts, and talk a little bit about what else is going on in the veg oil markets. But let's start with the EPA mandates. Last week, the EPA released their proposed mandates for 2023 through 2025, and the mandates, the 2023 mandate was below expectations and substantially below expectations. I think soybean oil prices fell limit the following day and have gone down by a penny or two every day since then. And that's a direct result of the mandate implies a significant reduction in soybean oil use in biomass-based diesel production and more broadly in feedstock demand. I cut our forecast for soybean oil use to 10.57 billion pounds, I think, and I'll show you the new balance sheet here in a minute. So USDA is going to need to make a substantial reduction in their cut from their November prediction of 11.8 billion pounds. The next 2 years, actually, the total mandate came in above what we had expected. However, the biomass-based diesel mandates came in below what we expected, and the way that the EPA structured the mandates had a substantial impact on expected biofuel production. So if we think about the mandate, if we think about how we figure out what biomass-based diesel production is supposed to be, obviously there's the D4 mandate, and that's the main component of what production is supposed to be. But then there are these gaps that biodiesel has traditionally filled, and biodiesel and renewable diesel have filled more recently. The first is what I call the undifferentiated advanced gap, which is basically the difference between the advanced mandate and then D5 production plus D4 production plus D3 production. And that is where the EPA mandates really sort of cut into the implied biomass-based diesel production in all 3 years, but in particular in 2025. So the EPA raised the D3 mandate a little bit in 2023, I think like 60 million gallons in 2023 from 2022, and then another 60 or 70 million gallons in 2024 from 2023. And then you really doubled it from 720 million gallons to 1.42 billion gallons in 2025. And the reason for that sort of odd structure is that the EPA plans to issue D3 RINs for electric vehicles. And what I've read I'm going to just sort of say up front that I've spent most of my time since the EPA released the mandates kind of just going through and rebalancing everything. And I haven't had time to take a deep dive or to talk to anybody at the EPA about how they propose to implement these EV RINs, but they plan to issue RINs for electric vehicles that in the story that I read that are powered by renewable electricity. And so it may be that there's a clear answer out there, and I just haven't had the time to look into it yet, but let's, just because this is where I am right now, let's suppose that that's what the EPA intends to do, which is to issue RINs for electric vehicles powered by renewable electricity. I think the best way for the clearest path for the EPA to issue the RINs is to issue them to EV manufacturers. But if there is this renewable electricity component to the RIN, once the manufacturer sells the vehicle, then I'm not sure how they track that. Now, if what they mean is, if I misread the article and what they really mean is EV vehicles produced by renewable energy or renewable electricity or using renewable electricity, then I suppose I can understand how that all fits together. And then it just becomes a question of how do you translate what an electric vehicle means in terms of fuel. So how much fuel does the average electric vehicle save? Is there a difference in the number of RINs that are issued if the electric vehicle is a passenger car versus a long haul semi-trailer or a forklift or other electric vehicles? So I think the easiest or the clearest path for them to issue the D3 RINs for electric vehicles is going to introduce another layer of complexity into trying to figure out exactly what production biomass-based diesel production needs to be, and then what feedstock demand needs to be. Because if that's how they do it, then one, we need to know sort of that conversion rate for each type of vehicle, and then we need to start to assume some adoption rates for vehicles. For some vehicles, it's going to be very high. Electric forklifts are sort of dominate the market already, and so California has kind of one of the steps that they've taken to correct the LCFS prices is the elimination of LCF credits for some electric forklifts. So I'm going to need to sort of go through and build all of that out before I can kind of say with any confidence, yeah, I think that that the 720 million, or the 1.42 billion gallons for 2025 is a realistic number, and kind of here's how I get there. In the meantime, I've just kind of taken the EPA's estimate as at its face value, and that's what I've based the forecast on. And based on that forecast, what you end up with is, and if you'll excuse me here for just a second, let me just pull up a spreadsheet so I can say these numbers accurately. It looks like to me that you get biomass-based diesel production of 3.194 billion gallons in 2024. That's a marginal increase of 51 million gallons from 3.143 billion in 2023 or 2020. Sorry, that's the 2022 number. 3.194 is 2023. Then it rises to 3.334 billion in 2024, and then 3.757 billion in 2025. So that's kind of where it is right now, based on, again, just sort of taking the EPA numbers at face value and using those to kind of calculate the undifferentiated advanced biofuel shortfall that needs to be made up by biomass-based diesel, and adding that to the biomass-based diesel mandate. The other mandate, or the other gap, is the ethanol gap. And so the gap between ethanol production and the ethanol mandate. And the EPA mandates also were a little surprising here in that they left the implied ethanol mandate for 2023 at 15 billion gallons, which when we add the 250 million gallon supplemental mandate, that gets us to 15.25. And then the implied ethanol mandate is 15.25 billion gallons for 2024 and 2025. I would have thought that the EPA would have let the implied mandate fall back to 15 billion gallons, given one, that there is a shortfall already, and then two, that that they want to incentivize electric vehicle use, hence the D3 RINs. And so that gap is going to be determined by, one, the growth in gasoline use and the rate of adoption of electric vehicles, passenger vehicles, basically. We have based our forecasts in the relative short term over the next 2 or 3 years on the idea that that we would get a little bit of growth in gasoline consumption year over year. Now, the gasoline demand this summer was really, really low. And I think we talked a little bit about this, that sort of during the summer, you saw gasoline demand fall below where it was during the summer of 2020, sort of peak lockdown summer. And I think that I think you could potentially sort of extrapolate that out and kind of say, okay, we may have already seen peak gasoline demand, and gasoline demand probably is going to be flat or decline sort of going forward due to electric vehicles, the increase in the adoption of working from home and other changes. But I still think that I think the summer was probably more a function of gasoline prices than it was of anything else. And so we still assume that there is sort of small year-over-year growth in ethanol demand. However, even when we left the mandate at 15 billion gallons, which in our prior forecast, we kind of left it at 15 billion gallons, just kind of going forward. And ethanol demand, if you just assume that it sort of continues to grow at a decreasing rate, it eventually gets to the point where production kind of bumps up on 15 billion gallons. So the 15.25 billion gallon mandate, I think, assures that there probably will be a gap between ethanol production and the ethanol mandate for the foreseeable future. Certainly, I think for the over the next 3 years. And I think that's important for 2 reasons. One, obviously, it means that there will be additional biomass-based diesel production that's needed to make up that gap. Some of it, I think, will also be made up by growth in sustainable aviation fuel production. However, the amount of the amount of SAF production that we have right now is so small. Even if you sort of quadruple it over the next couple of years, you go from sort of maybe 10 million gallons to 40 to 160. It's relatively small compared to the gap between ethanol production and the ethanol mandate, which is going to be a little bit less than 1 billion gallons, I think, in 2022. And so SAF will cut into that a little bit, but it certainly, I don't think, between growth in SAF production and growth in actual ethanol demand, I still don't think that you will get to that 15.25 billion gallon mandate by 2025. So I think the other way that I think what that implies is the other reason that the 15.25 is important is because while RIN prices are best correlated with feedstock prices, and we've seen that in spades over the past 3 or 4 days, where RIN prices have fallen dramatically in line with feedstock prices. The fact that we still will be short ethanol means that we still will have this situation where people will produce more renewable diesel or biodiesel, sell the D4 credit and buy the D6 credit, narrowing the spread between the two and actually lifting the price of both credits. Now, when we get into the RIN forecast, you'll see I don't think that means that RIN prices go up hugely, although I was surprised at kind of how high the RIN forecast, how high the model wanted to take the RIN forecast this week. But it does mean that support's there. Now, I don't believe that support overwhelms the change in feedstock prices. So if soybean oil falls to 50 cents, RINs are going to fall soybean oil down, and maybe not sort of cent per cent all the way down because of the ethanol blend wall, but they are going to there will be some cushion there from the ethanol blend wall. And so I think that was the other part of the mandates that was pretty surprising to me. The last thing I'll kind of say about the mandates, at least the EPA mandate portion of the mandates, is that for the D3, in addition to the EV RIN and its impact on D3 production, we've also had huge growth in renewable natural gas over the last couple of years. And just anecdotally, based on the number of calls that I get now from people that either want D3 prices or that are curious about the demand for renewable natural gas or something else about renewable natural gas, I would assume that growth is going to continue at least probably through the period that the EPA has produced proposed mandates for. Now, I don't know that it will continue to grow at the rate that it has over the past year or two, because there's a fair amount of that production that comes from manure pits on dairy farms or cattle feeding operations or municipal waste facilities. And so there is a limited number of those. So at some point, I think that is going to, that growth is going to top out someplace. And while the machines that sort of capture that methane and then kind of clean it up and put it into the pipeline may be able to increase the sort of the yield that they get. I don't know how much room there is. I don't think they're that inefficient now that even if they sort of capped off every dairy manure pit in the US in the next 2 years, I don't know that then you would get another sort of 25% growth or 50% growth or maybe even 10% growth sort of after they have gotten all of the gas captured that they can get captured. And so that part is also going to be something that I think is going to be important to understand kind of going forward, given the fact that the D3 mandate is now sort of, at least from my view, sort of acting like what it was supposed to be, or we're getting the growth, I guess, that we were supposed to have gotten years and years and years ago out of sort of cellulosic renewable fuel production. And it was something that, in the past I was able to just sort of pencil in kind of, 20, 30, 40 million gallon a year growth and kind of project that forward. And now I think that that line is probably going to be as important for biomass-based diesel production as or nearly as important for biomass-based diesel production as the biomass-based diesel mandate itself. Okay, that's kind of it for now on the mandates. Outside of that, we'll kind of go through a little bit on each of the veg oils, and then the other stuff. All right, so you can see I lowered the front end of the soybean oil forecast. I think that that the equilibrium price now is probably between 60 and 65 cents. However, it wouldn't surprise me if prices moved a little bit lower here in the short term, and maybe even substantially lower. I may ultimately end up having to lower that number. I don't think I'll end up at like 50 cents, but I think I might end up between 55 and 60 cents, just because the rebalancing the balance sheet after the changes that we made to, well, that's new. Oh, come on. I apologize. I don't know why this never works. That's so frustrating. Rebalancing the balance sheet after the changes from the sorry, I'm going to do something here just really quick while I'm talking. After the changes that I made to the biomass-based diesel production and feedstock demand, it wasn't difficult, because at the end of the day, really all I have to do is kind of raise exports a little bit, sort of put non-biofuel demand at whatever I think the max is, and then cut imports a little bit, and then whatever is left, I just kind of reduce the crush to get the ending stocks down to a level that sort of makes sense to me. And so, despite the fact that it's sort of that's just the process, it still is. It's hard to find enough demand for all the production, and that's particularly true if you think that the new soybean crushers and soybean refining plants that are going to come online over the next year, some of them are came online this fall, some of them are going to come online early next year, some of them are going to come online next fall. If those are going to operate at any sort of capacity utilization at all, if the industry is going to operate at any sort of capacity utilization at all, then it is you were going to get production that we sort of need to find a home for. It's almost like in the short term, soybean oil is going to be what we thought soybean meal was going to be, where and I think that's an exaggeration, but it highlights a point that that prices could fall to a level that that is lower than I expect anyway, I guess is sort of the way I say it. Now, I think in the longer term, I think that that there probably is still enough demand out there, and especially as you go out past 2025 and you really start to ramp SAF production up, then I think that what the EPA has done with this set of mandates does not sort of solve the feedstock problem or the the tightness of feedstocks. And so I think that, again, in the short term, I think long term, probably 65 cents is sort of the fair value, but in the short term, we could get down to 55 cents or maybe even a little bit below 55 cents. And it will just depend a bit on again, what happens in South America, and then how strong non-biofuel demand is, and then also the margins for biodiesel. So biodiesel and renewable diesel. And as you'll see here in a little bit, even the decline in energy prices and the decline in feedstock prices kept margins pretty close to where they were. Renewable diesel kind of kept going down, but a long ways from sort of absolutely cutting off demand from biofuel producers. And so there are the mandates, and that's what we use to try and predict what production is going to be. But I think we also need to think about the growth in the renewable diesel industry and the fact that renewable diesel producers are going to produce, and the industry has in the past carried huge balances of RINs for years and years and years. And I'm not suggesting that that's what's going to happen right now. And but I think that, one, the RIN bank is probably a little low, and so we're not way full up of RINs. And two, wherever the RIN bank is, some of the renewable diesel producers are going to operate to generate profits because they can. And until the production is at a level that forces rationalization in the biomass or in the biodiesel industry, feedstock demand may ultimately be stronger than everybody's first take at it following the announcement of the mandates, and just based on sort of the mandate math. I tried refreshing this and I couldn't get it to go, so I apologize. The bottom line on the soybean oil balance sheet, on the U.S. soybean oil balance sheet, is that my ending stocks number rose to 2.1 billion pounds. And again, and that's because basically I cut my crush forecast for 22-23 by 40 million bushels from 2.275 to 2.35, and that's 10 million below where USDA was in November. USDA is going to need to cut about well, at least 1 billion pounds out of their biofuel demand. They were at 11.8, and they're going to offset a portion of that with non-biofuel, and they'll probably raise their exports a little bit. I raised mine from 1 to 1.5, I think, or maybe I was at 1.25, but I raised it to 1.5. It'll be interesting to see whether we start to see in the weekly export sales data a pickup in U.S. sales. First, we're going to have to see basis at the Gulf fall, which we didn't really see last week. But if we don't get exports to start to speed up from where they have started this year, which has been just historically slow, then I think that then you could start to potentially have some real problems. So if the export number really is sort of 1.0 or 1.1 or 1.25, which, I mean, I think if you just kind of take the numbers that we have so far for commitments and extend those out in almost any way that you want to, you can make a case for those kind of numbers. Then you're going to get to a point where the crushers are going to have extra oil, and basis levels could really start to come in, because so far meal demand has been strong enough to support enough crush that that crushers haven't really needed to start to crush for oil yet, and have been able to find enough demand domestically and in the export market for soybean meal that they've been able to produce enough oil. If that meal demand stays that strong, then there's potential that we're back to, not quite, but almost to the days of where we kind of produce meal and then have a bunch of oil that the industry needs to figure out what to do with. Again, I think that as long as margins remain positive for biofuel producers, there will be that demand for the oil. So I think that's, you know, basis collapsing is a little dramatic, but I say that just to kind of highlight the fact that we, at this point, we kind of are going in a very different direction than we have been over the past couple of years, in terms of expectations and how the market's going to function. And that is why I think that ultimately soybean oil prices could shoot to the downside lower than I expect, and maybe significantly lower than I expect. There is also some upside risk. Of course, the weather in South America remains an upside risk. We talk about it every week, so I'm not going to say anything more about it this week, but there is some upside risk there. For canola prices actually fell to 80 cents this week, and that was the lowest price in sort of 2 years. But the EPA also announced the final pathway for canola oil to generate RINs in renewable diesel production. And anecdotally, we've heard that renewable diesel producers have been buying canola oil in anticipation of the finalized pathway. And so I think it'll be interesting to see over the next couple of weeks or a couple of months, when we eventually get the data from the EIA, how strong the demand is for canola oil, how much that actually grows. We don't have a bunch of canola oil built into canola oil used for renewable diesel production built into our forecast. And so the changes from the mandates weren't that significant. And again, I'm waiting a little bit to sort of see what the actual usage is going to be in these first couple of months of 2023 to see where I need to change my projections for canola, essentially. Outside of that, canola crush kind of continues to remain relatively high, but maybe not quite as high as I had expected it to be, and so we might get a bit of a bit more support in prices. And given the change in the outlook for soybean oil, the spread between RBD canola in Los Angeles and the spread in canola RBD soybean oil in Central Illinois has fallen to like 2 cents, and historically that spread has been about 8 cents. And so now that there's less pressure on soybean oil, I would also expect that spread to widen back to sort of its longer term average. That's probably going to keep a cap on canola crushing volumes to a little bit, or to some extent. The other spread that was really impacted was the spread between soybean oil and palm oil. So for soybean oil and palm oil, the December contract was at 38 cents in mid-November. That dropped to below 25 cents yesterday, and it's just a straight line down. I think that spread will kind of stabilize around here, although there are two developments that have been potentially bullish. One is sort of anecdotal reports out of India suggest that Indian buyers finally have restocked or started restocking palm oil. Palm oil exports were up. Palm oil imports into India were up 30% in November relative to October. and Indonesia's president asked his cabinet to put together a plan essentially to increase the mandate from B30 to B35. Ultimately, they're going to go to B40. Both of those things, I think, probably can provide some short-term support. But if soybean oil is just going to continue to move lower and lower and lower, it will drag palm oil down with it eventually. And the spread will probably continue to narrow, but it probably will start to narrow more slowly as it moves lower. Because while the Indian news is sort of not long overdue, but it's something that I've been waiting for it seems like forever. It is sort of a one-off event potentially. Now, the reason that Indian buyers were so much more aggressive in buying palm oil in the past month is because what the report said is because palm oil was discounted relative to sunflower oil and soybean oil. Well, palm oil has been discounted to sunflower oil and soybean oil, and so I think that may have played a role, and maybe a significant role, but it's something that has been around, and I don't know that it means that that there is a sea change in Indian buying, and now we're going to get the same level of imports sort of month after month after month after month. And so I think that I just think that spread, while it will likely continue to narrow, the spread between soybean oil and palm oil, it probably will start to slow down, especially once we get back below sort of 20 cents. And if we get down to, say, sort of 10 cents, then I think it will really start to slow down. And I'm not sure that I think that it will get there anyway. Let's see. Okay, so let's go to biomass-based diesel. The EIA released its monthly renewable fuels excluding ethanol production for September. That number came in just 2 million gallons above where we had projected it to be based on the EMTS data. However, based on last week we talked about the EMTS data kind of left the end of the year production lower, and typically we get higher production, and so I said I was going to adjust the production, and so I went back as part of the overall mandate adjustment and also adjusted production for the end of 2022, and so raised that production for that series by about 110 million gallons, so that production in 2022 is going to be just a little bit above where it was in 2021. And then in 2023, you can see there's a little bit of growth, but not really any significant growth, and I don't think that that's a huge surprise. All right, for gross margins, let's see if these work. Okay, so like I said, kind of the biodiesel gross margins have been hanging in around $1, and we expect them to continue to do that at least through the first quarter of 2023. But the renewable diesel margins fell down to just above $2, and we expect that they are probably going to remain at that level kind of into the first quarter of 2023. After that, we kind of have them starting to come back, but that's mostly based on an increase in energy prices as we work our way through sort of a potential slowdown in economic activity in Western countries, and then a reopening of China and the associated increase in oil demand that comes along with that. We've got oil prices or energy prices kind of coming back in the second half of 2023. And so that potentially will help support prices. And again, I think renewable diesel margins, renewable diesel production may need to go to a spot where it starts to rationalize renewable biodiesel production. And the way the indicator that that's starting to happen, obviously, will be a big collapse in biodiesel margins. As long as biodiesel margins remain sort of at the dollar level, then I think it's going to be hard to get biodiesel producers to close down. All right, RIN prices. So this is I struggled a little bit. The model really wanted to the model wanted much higher RIN prices than you see here. And I think that these are potentially, even, especially at the end of the year in 2025, I think these are potentially even a little high, especially the D4. You can see I've got the spread between the two widening out pretty significantly, and then starting to narrow as we get towards the end of the year. But this will depend, and this will probably change from week to week to week on where we go with feedstock prices. And so as feedstock prices move lower, this will move lower. I will probably get a little bit more aggressive in how in the changes that I make from what the model wants to predict as well, just based on the fact that the model is for the current month, the model is predicting prices that are sort of around 180 or so for D4, which is about 20 cents higher than they're currently trading. And so the models struggle a little bit with where we are right now. And that's because if you look at that's in part the reason that is that if you can see what we've done in the HOBO spread was here last month, and then it rose back up, and then it just has absolutely collapsed. And so that should make the model take the prices down, but it is not doing it. And part of the reason it's not doing it is because I've got soybean oil prices kind of at 65 straight across the board. So the forecast HOBO spread looks a little bit different than the forward curve in the futures market, and that's part of the issue. And that's why I kind of have changed it a little bit from what the model wants to do. For LCFS credit prices, we still are just kind of bouncing along at this $60-65 a ton level, and until further notice, probably going to continue to bounce along close to that level. Okay, with that, apologies for the lack of being able to bring up the tables. If anybody has any questions, please type them in the chat or in the Q&A. If not, we will be back next week. And thank you, everybody, for coming, and have a great week. I'll see everybody next week.